The market just flashed another warning for silver investors. What if the biggest warning sign in the silver market right now isn't the price? It's the fact that the price and the supply data are moving in completely opposite directions. Silver is down nearly 50% from its January high. Most investors see that and think one thing: the story is over. But 6 years in a row, the amount of silver the world produces has fallen short of the amount the world actually needs. And that gap is getting wider, not smaller. Two numbers, moving in opposite directions. One of them is lying to you. By the end of this video, you'll understand which one and why almost nobody is talking about it. In the next few minutes, you'll understand why silver's price can fall while its fundamentals get tighter, what the gold to silver ratio is quietly telling smart money, why this exact pattern has shown up before in 1979 and again in 2011, and which signals separate a genuine structural shift from just another bounce in a volatile metal. This isn't a prediction, it's a map. What you do with it is up to you. Let's start with what's visible, the part everyone already knows. Silver hit an all-time high in late January of this year, trading above $121 an ounce. By June, it had fallen by nearly half. Headlines called it a collapse, a failed rally, the kind of move that scares retail investors out at the worst time. Here's the part most coverage leaves out. A strengthening dollar and a hawkish Federal Reserve have been pressuring precious metals broadly, gold included. The Fed has been signaling more rate hikes, not cuts. And when interest rates rise, holding a metal that pays no yield becomes more expensive on paper. That's the mechanism behind the sell-off. Simple, logical. Almost everyone understands this part. But price is only one side of the equation. There's a second number that tells a very different story. But here's where things become interesting. While silver's price was falling, the physical market underneath it was getting tighter, not looser, tighter. The Silver Institute's World Silver Survey for 2026 projects the sixth consecutive year where global silver demand has exceeded global silver supply, 6 years in a row. Since 2021, the world has drawn down more than 760 million troy ounces of silver from above-ground reserves just to cover the difference. Think about what that actually means. It's not that silver became less popular, it's that the world is using more silver than miners can produce every single year and has been quietly eating into stockpiles to make up the difference. Here's the part that should make you pause. Most commodities can fix this kind of imbalance fairly quickly. Higher prices attract more production. Supply catches up. Problem solved. Silver doesn't work that way. Roughly 70% of the world's silver isn't mined on its own. It comes out of the ground as a byproduct of copper mines, zinc mines, lead mines, which means even if silver prices doubled tomorrow, most mining companies couldn't simply produce more. They'd need a new copper mine, a new zinc mine, and those take 7 to 10 years to build, from discovery to production. The supply side of silver is, structurally, almost frozen. So when demand rises, and it has, sharply, there's nowhere for supply to flex. That's only part of the story. Silver isn't one market, it's two, wearing the same name. The first is industrial. Solar panels, electric vehicles, semiconductors, AI infrastructure. Silver conducts electricity better than any other metal on Earth, and in many of these applications, there's no substitute that works at scale. The second is monetary. Investors holding silver the same way they hold gold, as protection against inflation and currency debasement. Here's why that matters. These two buyer groups don't move for the same reasons, and they don't always move together. When the global economy is humming, industrial demand rises. When investors get nervous about inflation or the dollar, monetary demand rises. In 2026, something unusual happened. Both pulled at the same time. And when both demand pools pull on a supply that structurally cannot expand, the result is exactly what we're seeing. A market drawing down inventories for 6 straight years. COMEX registered silver, the metal actually sitting in vaults, ready for delivery to buyers, has fallen by roughly 75% since 2020. From around 346 million ounces down to roughly 88 million. That's not a forecast, that's inventory on the ground, right now, shrinking. History gives us another clue. This isn't the first time silver has looked broken right before it wasn't. In 1979, silver spiked to historic highs, driven partly by the Hunt brothers' attempt to corner the market, then collapsed violently in 1980 when regulators changed exchange rules. That crash defined the public's memory of silver for decades, a volatile, speculative metal, not a serious asset. But that crash was about market structure and manipulation, not about whether the underlying metal was scarce. Jump forward to 2011. Silver surged toward $50 an ounce during the aftermath of the financial crisis, as investors fled into hard assets. It then fell hard over the following 2 years. Same pattern, sharp rise, brutal pullback, headlines declaring the trade dead. In both cases, the thing investors mistook for the end of the story was actually a correction inside a longer structural trend, not the trend's conclusion. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, is one of the clearest ways to see this pattern. That ratio spiked above 100 to 1 in early 2025, a level reached only a handful of times in the metal's modern trading history. Statistically, that's an extreme. More than 2 standard deviations from its long-term average, the kind of number that historically hasn't lasted. By the end of 2025, that ratio had compressed back down into the 50s and 60s. History doesn't repeat with precision, but it does rhyme, and right now, it's rhyming loudly. Now here's the signal very few people noticed. Section 5. Market psychology. Most investors focus on the price chart. They watch the candles, they watch the headlines, they feel relief when it goes up and panic when it goes down. But that's not the real story. Smart money, the institutions, the funds with decades of commodity cycle experience, watches something else entirely. They watch the relationship between price and inventory. When price falls and inventory rises, that's a real warning. It means demand is genuinely drying up. When price falls and inventory keeps falling too, that's a completely different signal. It usually means the price move is driven by sentiment and leverage, short-term trading, rate expectations, dollar strength, while the physical market underneath keeps tightening regardless. That second pattern is what 2026 has shown so far. This is the part where most retail investors get shaken out. They see red on the screen and assume the fundamentals broke. But the data suggests the fundamentals didn't break at all. The price simply moved faster than the physical reality underneath it. And those two things don't always travel in a straight line together. If you're finding this kind of analysis useful, consider subscribing to The Collapse Signal. Every week, we break down the economic signals shaping global markets before they turn into tomorrow's headlines. And if this video is helping you see the bigger picture, a like helps more people find analysis like this instead of noise. So where does this actually go from here? Nobody can say for certain, but the range of outcomes is narrower than the headlines suggest. Start with the bearish case, because it deserves to be taken seriously. If industrial demand slows, say solar installations plateau, or the global economy tips into recession, and the Fed keeps real interest rates elevated, silver could face real headwinds. Some analysts have noted that solar manufacturers already reduced silver consumption by close to 19% in 2026 as the industry works to use the metal more efficiently. Even in that scenario, most analysts see a structural floor somewhere in the $35 to $40 range, underpinned by the simple fact that solar, EVs, and electronics can't easily substitute silver out of their designs. Now the bullish case. If the structural deficit continues, which it has, every single year since 2021, and if the gold to silver ratio keeps compressing toward its historical norm, several major banks have laid out targets well above where silver trades today. Some forecasts for 2026 cluster in the $65 to $80 range. A few, built around aggressive ratio compression models, stretch considerably higher. These are forecasts, not guarantees. Wall Street has been wrong about silver before, in both directions. If this trend continues, the deficit doesn't resolve itself quietly. Commodity markets facing this kind of sustained imbalance have historically resolved it one of 3 ways: higher prices that ration demand, new investment that slowly unlocks supply, or some combination of both. One possible outcome, not a certainty, but it's the direction every available data point is currently leaning. The next piece changes everything. You don't need a Bloomberg terminal to track this story. You need to watch 4 things. First, COMEX registered inventories. If they keep declining, the physical squeeze is intensifying, regardless of what the price is doing day to day. Second, the gold to silver ratio. A ratio that keeps compressing below its recent range suggests silver continuing to outperform gold. A ratio that stalls or reverses higher suggests the move is losing momentum. Third, Federal Reserve policy. Rate cuts tend to weaken the dollar and support precious metals. Continued hikes do the opposite. This single factor has driven much of 2026's volatility already. Fourth, the Silver Institute's annual supply and demand data, released each spring. A seventh consecutive deficit would be unprecedented in the survey's history. A surprise surplus would be the clearest sign the structural story is finally changing. Track these four, and you'll understand silver's trajectory better than most people holding it. So here's a question worth sitting with. Given a metal whose price is falling while its physical supply keeps shrinking, is that a warning sign or a window? Tell me in the comments. Are you buying into this dip, waiting for confirmation, or staying on the sidelines entirely? Section 8. The big takeaway. Here's what ties all of this together. Price and fundamentals are not the same thing. They usually move together, but not always, and not on the same schedule. Silver's price reflects today's sentiment, interest rates, the dollar, fear, momentum. Silver's supply-demand data reflects something slower and far harder to fake, physical reality. Mines that take a decade to build, inventories that take years to draw down, industrial demand that doesn't disappear just because a chart turned red for a few months. When those two things diverge, when price says one thing and physical reality says another, that divergence doesn't last forever. Eventually, one of them moves to meet the other. History suggests it's usually the price that catches up to the physical reality, not the other way around. That's not a guarantee, it's a pattern. And right now, that pattern is sitting in plain sight. Markets rarely reward those who react to headlines. They tend to reward those who recognize the signal before it becomes the headline. Silver has spent 6 years building a story that most investors haven't read past the first chapter. The real question isn't whether the imbalance is real. The data already answered that. The real question is whether you'll recognize the moment it resolves, or whether you'll be reading about it after it already happened. If you found this analysis valuable, subscribe to the Collapse Signal for more in-depth market breakdowns. Like this video if it helped you see the market differently, and tell me your take in the comments. And if you want to stay one step ahead, watch the next video on this channel, because the next signal may already be forming.